say that there's a rule of thumb to how we should maybe make an attempt to accelerate our payments on a mortgage? Does it make sense to you? And also, would you say that what would be better for certain people? I guess a 15-year mortgage, a 30-year mortgage, an ARM. Do any of those certain products have any ups or downs or catches?
Okay, definitely a tough question. Okay, one of the most emotionally charged topics in our entire country are the subject of mortgages, especially in light of what's happened and transpired recently. To me, I try to look at it from a financial standpoint and take a look at a few different factors that may impact the mortgage. The first of which is, number one, purchasing a property that you can afford. Many of the financial challenges that we've faced were due to the fact that people overextended themselves and, again, bought into the fact that they earned it or they deserved to have a gigantic home that they could not afford because the marketing companies sold them on the fact that this is the American dream and they need to own it. They deserve a gigantic house, okay? So hopefully we take a look at, again, the mortgage scenario and the property ownership scenario in the confines of a larger plan, which is that hopefully you're able to purchase a property that indeed works within the ratios of what you and your family can actually afford, okay? That's rule number one. Number two would be to say there are so many different mortgage products out there. How do you know which ones make the most sense for you and for your family? And the first question I look at and say logically would be, if banks made the same amount of money on every mortgage possible, 30-year, 15, ARMs, adjustables, etc., there were so many options. If they made the same amount of money on each option, how many options would there be? Right? There'd be one option. So as a consumer, wouldn't you like to know which ones they make more on and which ones they make less on so that you can take that knowledge, turn it around, put it in your favor, and minimize the impact of the middleman? And that's what our goal is, okay? There are lots of different ways to structure programs, but in general, the products and programs that have been around and stood the test of time are typically the best going, okay? Personally, my belief is that if you can borrow dollars at a low interest rate and pay them back over time and keep your money working for you in other areas, that is generally speaking the best way to pay for your house, okay? Many people make the mistake of viewing their mortgage as a debt instrument, as a bill every month. They see it as a giant bill, perhaps their largest bill that they'll ever face, and they want to get rid of it or eliminate it as soon as possible. I mean, I remember when I first bought my first home, when you look at the truth in lending disclosure, you're borrowing $300,000, you're paying back $900,000. You're borrowing $500,000 and paying back $1.5 million. You say, my God, I got to get rid of this thing as soon as possible, right? And that's a normal knee-jerk reaction. Why would I want to pay back 5 times what I'm borrowing just to live here? I got to pay this thing down fast. And if we remember back a few generations ago, when mortgages were callable, we also had the situation during the Great Depression where banks called in loans, right? There were movies and plays and all types of things written about the fact that people had mortgages in the 30s, and when the banks needed money, they just called in the mortgages and said, you have to pay us back all the money today, and if you can't, we're foreclosing on your house. So there were generations of people who believed that debt and mortgages are terrible, the worst things, and many of the lessons that we believe in financially are the lessons that have been passed down to us from generation to generation. Lessons taught to us by our parents, our grandparents, and their parents before them, through things they lived through. And the people who lived through the Great Depression and other financial periods of unrest have different philosophies, for good reason, okay? Today, in our modern day world, in a banking system, there are rules in place to make sure that banks cannot just arbitrarily foreclose on a traditional mortgage anymore. There are payment schedules, and as long as you adhere to the terms of those agreements, they can't just call it in if you have a traditional 30-year mortgage or maybe a 15-year mortgage. You know what your payments are going to be. The taxes may vary, but the payment itself, the principal and interest, will remain the same, okay? So to me, the first question is, when are you debt-free? Okay, I believe you're debt-free when you have all the money to pay off your mortgage. I don't necessarily believe you're debt-free the day that you terminate the mortgage commitment and you tear up the mortgage and say, hey, I'm done, I don't have a mortgage anymore. For the same reason as we talked about a debt issue earlier. Okay, when are you debt-free? If I have $1 million in the bank and I owe $1 million, I can take the money out of the bank, assuming there's no prepayment penalty on my mortgage. I can take the money out of the bank, give it to the mortgage, and I'm debt-free, right? Okay. So knowing that, what I'd want to do is make sure that I have the cash flow available and now that I can utilize the mortgage as a financial tool, as an instrument. Today, okay, in 2011, mortgage interest rates are at or near an all-time low. It's amazing to me that people aren't just pulling off the road, borrowing as much money as they can. I'm not suggesting that you do that, but from a mathematical standpoint, think about it. If mortgage interest rates are, in the mid-4s or sub 5% that you can borrow at, and you can take that money out, borrow money from me at 5%, and pay it back over 30 years, and use those funds for something else, there's got to be some merit to that argument, right? The classic example would be that I recently sold my home. I'm going to downsize and move to a smaller place for my retirement years, and I have a choice. I have $500,000 of proceeds from the sale of my house, and I'm considering buying a $300,000 condo. Do I want to pay cash for the condo, or do I want to take out a mortgage? And most people would, the vast majority would raise their hand and say, I'm paying cash, no doubt about it. It doesn't make sense to borrow money. That's when you consider the cost of debt. Now you have to look at the other side of the coin and say, what is the cost of opportunity cost lost when I put that money into the property, okay? This is where you have to understand. One of the first concepts I learned about with opportunity cost at Wharton was the true cost of financing. Once you understand that everything in the world is 100% financed, it makes more sense. What do I mean by that? When you borrow dollars, you transfer interest to someone else for the privilege of using their money, right? So that's a financing cost. When you pay cash, you lose you forego the interest on what it could have grown to for you had you been able to hang on to it for yourself, okay? So it's two sides of the coin. You can't have it both ways. You either borrow the money and pay interest, or you spend cash, don't borrow, but you lose what it could have grown to for you. And now you've transferred that future interest to the bank or some other financial institution. So if we know that, and we know that our goal is to be debt-free and use the mortgage as a tool, over long time periods, wouldn't it make more sense for me to borrow the money and take that capital and put it to use for at least a short period of time, if not for longer, okay? Let's ask another question. If you could pay me back in one payment, would you rather make that payment to me in 15 years, in 30 years, or in 5 years? Right? Most people would rather pay it back to me in 30 years, right? You have use of funds and the ability to generate additional interest for 30 years until you have to pay me back. So what could you do with that money? All right. Again, I would not take the money and stick it in the stock market. Why? Because that's a foolish bet. You're hoping that the market's going to do well. You're hoping that